Welcome to the first episode of this new series I'm super excited to do called Buy the Dip with a question mark because we're not sure if all these companies we're going to talk about are worth purchasing at their current price, even if they are on sale. So today we're talking about WBA. This is Walgreens Boots Alliance, commonly known as Walgreens. They're on tons of corners, probably relatively near to you if you live in a city. And they've been beaten down like crazy. We'll talk about that. We're going to talk about why they're beaten down. We're going to talk about if it's a good idea to purchase now or in the near future. And I'm going to say if I am going to purchase these and my plan if I was to purchase these. And we'll look at their dividend history, talk about it. It is typically a phenomenal stock. 10 years ago, I would have been dying to get into the stock. Now it's a little bit riskier. And we're going to talk about why. So first things first, we'll look at this 6-month chart down 40%. The 1 year, they're down 40% as well. 5 years down almost 72%. Now, there's a number of reasons for this. None of them are very hopeful in my opinion, but you guys should always do your own due diligence and form your own opinions on these through your own research. Down 78% from the high of 2015. So people are asking what's going on with this company, and there's a lot that goes into these huge multi-billion-dollar companies. Like this market cap is a near $20 billion market cap. The main thing with Walgreens is their outstanding debt. They have a phenomenal amount of outstanding debt. And by phenomenal, that's a bad word. They have a huge amount of outstanding debt. And so part of the reason for this sell-off, I believe, is because their debt is so massive and interest rates continue to rise, which means they're paying more for that huge debt. And when debt prices increase, which is kind of funny, but when they increase and you're making the same amount of money, even you're making a little bit more, it's hard to combat that increase, especially when debt goes from 3% to almost 8.5%. So this max chart is pretty ugly. They were doing really, really well. But what shocks me with this stock is if we look back, it is trading at $21.37 right now. It has not traded this low since like 1998. Yes, even in 99, it has not come down. Even in the crash of 2008, what was the low? 22.59. It's lower than that. So, I mean, after that crash, look at this. After that crash, it had a phenomenal run, 200, 300%. But we need to talk about if that's going to happen again. So that's the point of the Buy the Dip series, and I hope you guys enjoyed. Let me know in the comments, but let's get into their dividend history. So I'm using Seeking Alpha. We can see their 5-year history pretty good, 10-year history pretty good, max phenomenal. This is beautiful. I love this. It is 47 consecutive years of dividends, and it is stunning. So they're close to the Dividend King mark. They're not there yet. They've got a bit to go, but they are pretty close. They've far surpassed Dividend Aristocrat, and just stunning. Now, if we go to their payouts, one thing that immediately I noticed is that they actually have they haven't cut their dividend. That was a really poor choice of words. They have stopped their growth of the dividend. So we can see, I think they normally pay out June, July, and they did not increase the dividend this last Q3. So if we look down here, we can see 2022 Q3 increase, 21 increase, 20 increase, 19 increase, 18, and so on and so forth, all the way down past 16. That's when they do their dividend bump. And people count on that a lot, which is part of the reason why people, I think, might be jumping ship on this one a little bit. But it's also really important to note that that could be a good thing. It's weird to think of a potential dividend cut as a good thing, but if the company knows it can't pay out, if let's say their payout ratio is far too high, they don't have the money to pay out the dividend, they should not be increasing the dividend, because all that's going to do is pay out more money to the shareholders, and then the company has less to work with. So I always think shareholder value is the most important thing, but it's good to know that the company is also looking out for itself, because overall, if they pay out a high dividend and then have to cut it, you're going to lose a lot more share value than you would if they just not put out a higher dividend, continued that dividend, and became a Dividend King. Those are my 2 cents on it. Seeking Alpha has a bunch of free information, guys. You can see their dividend scorecard. Maybe you can't, but their current yield, almost 9%. Pretty insane. They're paying out 50 cents each quarter, 48 cents each quarter. I should be really accurate. Payout ratio, 50%. I think it's a little bit higher than that. This might be a little bit old. Annual payout ratio, $1.92. 5-year growth rate, 3.2% is not great. 46%, 46 years of dividend growth is actually, I believe, is 47 now. But this is not a huge 5-year growth rate. We'll talk about that a little bit because it does talk about their compound annual growth rate, which is CAGR. We can see their 4-year average dividend yield. They are almost double the sector average, which is important to note, but they are really high right now because as the price is falling, that dividend is increasing, especially since they haven't cut it. So the longer they take to cut it, even if they do cut it, if they don't cut it at all, if the price continues to come down, that dividend is going to keep going up. That's how the price and the dividend fluctuate. That's really important to note. So they get an A+ on dividend yield and forward yield. Dividend growth, they have a D+. I'm not sure why. We are sure why, because it's only 3.2%. Is that what I said over the last 5 years? And the sectors typically grow faster than that. Now, one of the reasons why their dividend doesn't grow as fast is because, like I said, they are a huge company. And so they may not be putting all that money into dividend growth, especially with how much outstanding debt they have. You have to think, what is the company? What is the CEO, CFO? What are they thinking about what they're going to do with the money? They want to push that into the company and have it be more profitable, pay off debt, because they're losing money on that debt. So it's really important. So here's CAGR, 3-year is 1.4, which is not good at all in my opinion. 5-year 3.2, 10-year 5.35. So definitely low on the CAGR, but you are getting really consistent dividends and a great dividend history, which is why it's probably a little bit lower. They don't need to continue growing their dividend at higher rates when you already have solid dividend history and people trust the company or are at least used to it. Now, dividend safety, this is where it's weird. Their cash dividend payout ratio. So, okay, I was confused by this at first, but their cash on hand, I'm guessing is what this is. Cash dividend payout ratio is way out. They cannot do it. Their normal dividend payout ratio, 50%. So not terrible. There is a big difference between those, though. Interest coverage. So you can go through and read all this information. I'm not going to go through and bore you guys with all of it, but there's some great stuff on Seeking Alpha. What I want to do now is do a drip calculator. So we're going to put in WBA, and we're going to see how much you would own if you had started investing it in January 1 of 1995. Let's go to 98, because that's when we were tracking from their dividend history. We're going to compare it to SPY, which is what? S&P 500 index. Okay. So this, when I first looked at this, I was really surprised. I actually had to stop and rethink about it. So WBA, you'd actually, over this insane time span of 25 years, you would only have $11,000 with a $10,000 investment. Looking at SPY, you would have $66,500 with dividends reinvested for both of those. So this is not good. You would be much better off investing in SPY, and that's why I think people need to take note of that and use this dividend drip calculator, dividendchannel.com. Phenomenal. You can see what your money would actually be like had you invested in the beginning. I love using it, especially for older companies. It's really useful. And this was one of the main turnoffs to WBA for me, because I want to see money growing. If I just noticed that it's actually lower with dividends not reinvested, which is important to note. Now, they have had a pretty bad downturn. Looks like you would have been at 30 grand, and since then it's fallen off nearly 80%. So we can understand that. See, fallen off up here too. It would have been 35,000, and now it's fallen. So the recent years have been really bad for it from 2015 on. But before that, it wasn't doing much either. It rocketed in 2015 and then sold off. So starting investment, like I said, 10,000. Pretty good information here. 25.8 years. I've been doing that math mentally. I didn't realize it said it right there. Average annual total return, 0.5% versus 7.6%. So you're not even countering inflation with dividends being reinvested in WBA. And without dividends reinvested, you're higher at 1.44%. Now, your average annual return is higher with SPY with dividends reinvested. Important to note, if you guys like to invest in SPY, I do. I think it's great. I think it's a good diversification tool. Now, we're going to talk about what is the future of WBA and what has been happening. So like I said, the outstanding debt, higher interest rates are not helping this company at all. And this article, let's see, it's on NASDAQ.com. It really gives a good look into all of this. It talks about their debt in more detail than I'm going to go. A lot of some big keywords in here, and I don't want to go through and use over complicated jargon just in case people don't know. If you're a little bit newer to investing, if you're not, I'll link the article actually in the video description. You guys can go read it for yourself. So they did sell a big corporation. They're going to get some money from that, and they're using that to pay down some of their debt, which is a good thing. And share sales should help with ongoing deleveraging, which is paying off that debt because they're way overly leveraged. And they're selling shares of it. They're not selling the actual company, which is interesting. They did go through a leadership transition, which is important. Their CEO is stepping down, or did step down August 31. Yeah. And they're going to be filling that role. I don't think they said who they were going to be filling it with. Now, she was in that position for 2 years, not even 2 years. So, I mean, it was a really tough 2-year period. I don't know if we can blame her specifically. You typically shouldn't, just with one company's management. There's a lot of factors that go into it, especially with how the market has been going and how Walgreens boomed with the pandemic and then sold off because people are using it less and less. Now, talking about the important thing that we're all here for, is their dividend in danger? And the short answer is yes, it is. They have enough to pay out their dividend currently. They're not increasing it because it's so close, that margin that they have enough to pay out with. But that's when you're getting scary. Again, I don't think it was dumb for them to not raise their dividend. They want to keep their title going. We'll see what Q4 does if they do end up increasing it. But I'm really, really curious. Like they say here, still the dividend is barely covered. Operating cash flows during the past 9 months were $1.22 billion, which couldn't reach the underlying dividends paid for the period of $1.24 billion. Management is worried about the dividend coverage, of course, because they want to be dividend kings. You get a crazy good status with dividend kings, reliability, everything like that. They skipped the hike, which signals lack of affordability in payouts. Now, the analysts believe in 40% upside. You should never just blindly follow an analyst. Even the best ones still are wrong like 40% of the time, and that's like the top-notch best ones. So, read what they say. If you agree, maybe you purchase it. If you've understood the downsides, not financial advice, of course, but understand the full story about what is happening with these companies. That is the most important thing with investing that I think people don't utilize enough. We have so much free information out here, guys. YouTube is full of information. I spend hours a week on YouTube listening to different stocks. Even if I'm not buying the stock, like let's say with WBA, I watch videos on it to see if there's a potential that I would want to buy it in the future. WBA has a phenomenal dividend history, and if they are 6 months to a year out from now and their dividend is still strong and they're still growing it, that would be a good green flag for me, as long as they have started to pay down some of this debt or at least minimize some of this interest they're paying on it so they have more overhead cash flow. So in the conclusion of this, it's at a critical juncture. So they're saying it's 50-50, you could say, maybe 60-40 towards a cut. And again, I wouldn't purchase it now, but I would wait. And if it did cut, that would be a great opportunity to look into purchasing, because when they go through these dividend cuts, they are going to lose a lot of people via selling shares. And so that it will drop. And that could be a good opportunity if it's a stock that you were looking to buy anyway. Now, I wouldn't put a ton of money in right now because, like I said, if they do cut, you could lose some value when it drops. And then you could dollar cost average too, which I love dollar cost averaging. So it all depends on what you're looking for, but still follow these stocks. They're important. And so that kind of concludes the buy the dip. Like I said, I am not buying currently, but I'm going to be watching it extremely closely. Let me know if you guys own this stock or if you are thinking about purchasing it kind of like I am in the comments down below. I always love comments and interacting. You guys have so much wisdom, and when you pass it up to me, I am super grateful. So I appreciate you guys for watching all the way to this point. There'll be more videos coming out this week, so if you are interested, like, subscribe, and comment. It helps out the algorithm, and we've been growing the channel pretty nicely, but it's all up to you guys. You guys have been phenomenal, and I appreciate you more than you know. So as always, guys, I will see you in the next one.